Welcome to the Tax Sale Podcast, where tax law investing is made easy. My name is Casey Dimon. I'm a tax sale veteran and expert. I'm the author of the Tax Sale Playbook, founder of the Tax Law Academy, and I am your host right here on the Tax Sale Podcast. Thank you so much for joining me on this podcast episode. As a reminder, this is a completely free podcast. I don't charge a membership or listening fee or anything like that, and it's brought to you through and because of the Tax Sale Academy. So if you are looking to learn more about investing in tax defaulted real estate, just head on over to our training platform at taxsaleacademy.com. All right, today we are talking all about tax liens. Now, I've done a number of episodes and training videos on liens and deeds both, but today I want to discuss some of the most common questions, comments, and concerns that I get about investing in tax liens. Hopefully, if you're a new investor, this is going to be an all-encompassing video that will help serve to answer many of your questions or your thoughts that you might have going on in your head. So first things first, what is a tax lien? A tax lien is a priority lien against a parcel of real estate for failure to pay the taxes. What does that mean in layman's terms? Obviously, taxes are very important for local governments to provide things such as schools, law enforcement, roads, sidewalks, emergency services, fire rescue, water management, and many other things that we often take for granted. Much of that money comes from real estate taxes. No taxes, no services. So when somebody fails to pay the taxes on time, the county must take action to protect that tax revenue. In some states, they do this by selling a tax lien to an investor. This is done shortly after the taxes go delinquent. The investor buys the tax lien certificate and essentially pays the taxes on behalf of the owner. In exchange, they earn interest on their money. Their investment is protected with a lien against a piece of real estate. If the owner, the delinquent taxpayer, fails to repay the investor in the required period of time, the investor can foreclose that lien and take ownership of the property. That is it in a nutshell. Now that we understand the basics, let's discuss 10 things that are commonly asked about tax liens. First off, there are a number of different types of tax lien systems. This is not an episode breaking down the differences in depth, but I do want to recap a couple. There's a bid down system where everybody pays the same amount of money, and the person willing to accept the lowest interest rate will win that lien. Then you have an overbid or a premium bid system. This is where investors pay an increasingly higher and higher amount of money for the same tax lien certificate. Of course, when they pay more money, this lowers their overall return because the interest is set at a flat rate. In some areas, that premium or the overbid earns interest and is returned. In other areas, the premium is not returned. That's just a very quick overview of a couple of systems that are most common, so be sure to do your research so you know what's going on with your specific system in the area that you're investing in. Now, a lot of people ask, can I just buy the lien as a cheap way to acquire real estate? So, your lien is in fact backed by the underlying real estate. You need to make sure the value is there in that real estate. Some new investors that just hear about this business believe you can simply purchase a tax lien for the amount of back due taxes as an easy way to acquire ownership of that property. You simply wait a year or two, you foreclose that lien, get to own a property for not a whole lot of money. Unfortunately, it is not quite as easy as just paying the taxes, getting a lien, and waiting it out. The truth is the large majority of the tax liens get redeemed. Banks or lien holders will step in and pay them off. Owners find the money, properties get sold and paid off at closing, that kind of thing. The stats say that around 95% of all tax liens get redeemed prior to the foreclosure period. Of those remaining 5% of liens that do become foreclosable, you need to remember that a chunk of those are going to be worthless properties. All right, next one. All right, is your money guaranteed by the government? So some people in the marketing space will tell you it is, in quote, guaranteed by the government or government guaranteed money. Unfortunately, that's not entirely true. The process is guaranteed by the government. Your money is not guaranteed by the government. The process is written to law. It's written in state statute, and I encourage you to read that. Your money is nowhere to be found in that state statute. The process by which you are participating in is guaranteed, but there's lots of ways to lose money if you don't do it correctly. But first off, when it comes to the government guaranteeing my money, I don't trust the government to guarantee my money. What happens is your money comes back to you when the property either gets redeemed or when you foreclose on that property, take ownership and decide to sell it or otherwise utilize it. If you overpaid for a tax lien, however, depending on the state lien auction structure, you could easily lose money. Likewise, if you buy a lien and you foreclose on a property and the property is worthless, such as a ditch, again, you're easily going to lose money. It's only guaranteed if the investor knows what they are doing and they don't make any mistakes. The government does not guarantee your money. The process is guaranteed, but it's all backed by your ability to make the investment successfully. The next one, you'll likely beat the market, but you're not going to make 30, 40, 50% off of most liens. We have to remember, we're in a competitive capitalistic market. If there isn't anybody else on earth looking to make money for some reason, you might be able to get the TikTok worthy returns. But most of the time, the majority of lien investors are just looking for a fair return on their investment, with the understanding that if they are not repaid, then that return will increase significantly. The next one, like every investment, the more secure it is, the lower your return will be. And by using the word secure, I'm referring to the value and the stability of the underlying asset of that lien, which is the real estate, as well as potentially the owner of that real estate. So if you're investing in a big box retail center that has a tax lien against it, you had better be willing to accept a pretty low rate of return on that tax lien, since it's a very stable asset. On the contrary, if you're investing in a vacant lot in the middle of nowhere that you might or might not be able to sell, you can probably expect a higher return if everything works out in your favor. More risk, more reward. Lower risk, lower reward. It's just like that in our economy. Next one, there are a lot of different strategies that depend on your objectives. If you're looking to earn interest on your money, you can buy safer liens that are more likely to be redeemed. For example, buy that single family home in a middle income area that is owner occupied and has a mortgage on it. If you're looking to become the owner of a property opposed to having the lien redeemed, you can look for something like a vacant lot owned by an estate that is located in Germany, where the deceased owner purchased it 30 years ago and the children likely forgot about it. So depending on how you strategize can increase the likelihood of the result that you're after. The next one, some tax liens are losers. Like every type of investment you can make, sometimes there will be products or opportunities that just don't work. Buying liens in ultra high tax areas might not make that much sense. Liens on worthless real estate might not make that much sense. Liens in high competition areas might not make a whole lot of sense. Just because you're investing in tax liens does not mean every single lien is going to be successful. Some liens you need to skip. So it's very important to understand exactly what you're doing and knowing everything you can about what you're buying. Next one. Ideally, you should be able to hedge your bets. Unless you're extremely risk tolerant, you likely should not be investing your life savings into the riskiest liens. The liens where you likely need to foreclose, then become the owner, and you have this property you might or might not be able to sell. Instead, create a portfolio that has a mix of stable liens and perhaps less stable or less secure liens and a number of different product types in a variety of areas. Many successful tax lien investors also add in a number of different tax deeds depending on their objectives as well. Be diverse in how you invest. The next one, tax lien investing is a slow game. It is not going to make you rich this month or next month. It's a long-term wealth building business that requires time to see the full effects. Far too many people tend to get out of this business just before the accumulative effects of their investments begin to take shape. If you cannot stick with it over the long term, find something else to do. And lastly, let's compare it to tax deeds. So a tax deed is basically a different type of delinquent tax sale system where the county holds the tax lien in-house, it forecloses that lien itself, and then they sell the actual property through a tax deed sale. So With a tax lien sale, you're buying a lien. With a tax deed sale, you're buying the actual property. When we compare the two, most tax lien holders will make their money when they walk outside, they check their mailbox, and they get that redemption check. They walk outside, cash a check, that's it. Most tax deed holders will only realize their profits when they actually market and then sell that property, take it all the way to closing, which is significantly more work than walking outside to your mailbox. So generally speaking, liens will provide a lower amount of return, but require less work, while deeds will provide a higher return, but require more work and more time. Again, ideally, you have a mix of both. So there it is. There's a few things about the tax lien business that'll hopefully help out some new tax lien investors. I truly hope that this episode has helped you out. If this episode or any of the episodes here on the Tax Sale Podcast have helped you out, please do me a huge favor. We don't charge anything like a membership fee or listening fee for this podcast, but your reviews really mean a lot to us in the algorithm. So please take just a few seconds out of your day to leave a 5-star review or a positive feedback comment on whatever podcasting or video platform you're listening to us on today. And you never know, that review that you write might serve other people to learn about this business simply because you took the time to write it or even just to tap that 5-star review. And as always, if we can be of any additional help when it comes to the tax sale business, make sure you check out all the links in today's show notes, including one to our training platform at taxsaleacademy.com. Hey, take care, folks, and make it a successful day. See you next time right here on the Tax Sale Podcast. Bye-bye.